If you're gearing up for your competitive exams, you know how crucial foreign investment is as a topic. So, in this explainer, we're going to do a deep dive into all the numbers and the new rules for the 2024-25 financial year, giving you exactly what you need to know. Let's get right into it.
Okay, so first things first. Before we jump into the crazy numbers, let's be clear on who our main character is, the Foreign Portfolio Investor, or FPI. Think of it this way. They're not buying the whole grocery store, they're just buying shares in the company that owns the store. They're investing in assets like stocks and bonds to get a return, but they're not looking to run the company.
And look, understanding their behavior is absolutely critical, because these investors move billions of dollars, literally with the click of a button, and that shapes our markets in a huge way. After a year of record-breaking inflows, the 2024-25 financial year saw a massive change in their strategy. So, the big question is, where did all that money really go?
To get our heads around this, here's our game plan. We'll start with the new rules SEBI brought in. Then we'll get into the nitty-gritty of the scorecard for the year to see what FPIs actually did. We'll also give a quick update on another key player, the foreign venture capital investors, before we wrap it all up with the most important takeaways for your exams.
First up, let's talk policy. To make India a more attractive place for foreign money, our regulator, SEBI, really honed in on one big theme: ease of doing business. So let's break down what they actually did to make life easier for these big investors. Now, if you look closely here, you see a really clear pattern. From making the application form simpler to letting investors get their money out way faster, we're talking T+1 day, which is the same speed as our domestic institutions, the goal was all about making the whole process smoother. They even set up a dedicated support cell to, hold their hand through the process. But hey, it wasn't just about rolling out the red carpet. On the flip side, SEBI also tightened up the rules in a few key areas to make the whole system stronger and more transparent. Let's take a look at those changes. And this is where you can see SEBI's two-pronged strategy in action. On one hand, you've got liberalization, like allowing 100% participation from NRIs and OCIs and FPIs that are based in Gift City. But on the other hand, you have a tightening of the rules for more complex things like offshore derivative instruments, or ODIs, just to make sure everything's above board. Okay, for all you exam takers, this new ODI rule is super important. To help you remember it, just think of this phrase: one-to-one direct investment. What does that mean? It means one ODI has to be directly backed by one actual security. You can't use other derivatives anymore, and the hedge has to be a perfect one-to-one match. This is a huge move to boost transparency. All right, so with all these new rules setting the stage, how did foreign portfolio investors actually behave in the market? Let's get to the scorecard and crunch the numbers for 2024-25. This chart really tells a story of three completely different years. You had a net outflow, money leaving India in 2022-23. That was followed by a historic, just massive inflow in 2023-24. And then in 2024-25, things cooled down a lot. Still a positive inflow, but way smaller. This was mostly because of rising U.S. bond yields and a lot of global uncertainty making investors a bit jittery. Now that positive number, around 20,000 crores, might look pretty modest, but it's actually hiding a massive, dramatic seesaw that was happening right under the surface. That net figure really doesn't tell you the whole story. The real action was in the split between the equity and the debt markets. Yeah, the story of 2024-25 for FPIs is truly a tale of two markets. While they were pulling money out of one hand over fist, they were pouring it into the other. Let's look at the exact figures, because this is where it gets really interesting. First up, the equity market, a massive outflow. We're talking FPIs pulling out 1.3 lakh crore rupees. The main reason? They felt Indian stocks were getting a bit too pricey, especially when other global opportunities started looking better. So where did that money go? Well, it went, and then some, straight into the Indian debt market. FPIs pumped in a staggering 1.4 lakh crore rupees. And the single biggest reason for this was India's government bonds getting included in major global bond indices, like those from JP Morgan and Bloomberg. So, you might be thinking, if they sold so much in equities, their total holdings must have gone down, right? Well, not exactly. The total value of assets they held, we call this assets under custody, or AUC, actually grew to 73.8 lakh crore rupees. And this chart shows you where that huge pile of money is sitting. As you can see, financial services is still the undisputed king, holding almost a third of everything. And geographically, where is all this money coming from? Well, no surprises here. The United States is still the heavyweight champion by a huge margin, accounting for nearly 40% of all the assets. Singapore and Luxembourg are next, but they are a distant second and third.
Okay, let's switch gears for a second and talk about another important group, the foreign venture capital investors, or FVCIs. While FPIs are playing in the big public stock markets, FVCIs are the ones funding the next big thing, investing in early-stage startups and unlisted companies.
So here's the interesting takeaway for FVCIs. You've got this contrast, where on one hand, the rules are being made simpler and more efficient for them. But on the other hand, the actual investment activity, well, it slowed down quite a bit in 2024-25. Cumulative net investments actually fell by over 11%.
All right, let's bring it all home. This is the most critical section for your revision. We are going to consolidate everything we've talked about into clear, exam-ready points. So, pay close attention.
First, the numbers. You absolutely have to commit these to memory. The overall net investment for FPIs was positive at 20,018 crores. But the real story is that split. A negative 1.3 lakh crore from equity and a positive 1.4 lakh crore into debt. Total assets stood at 73.8 lakh crore, with financial services as the top sector and the USA as the top country. Got it?
Next, let's talk about the why behind those numbers, the big policy shifts. Remember the major theme of ease of doing business. For IFSCs, remember that 100% NRI participation rule. And for ODIs, please don't forget our mnemonic, one-to-one direct investment. And finally, the key reason for the flood of money into debt was India's inclusion in those global bond indices.
And for the FVCIs, the summary is nice and simple. Just remember two key trends for the year. One, the regulations were streamlined, now handled by designated depository participants. And two, there was a clear investment slowdown, with a decline of 11.6% in their cumulative net investment. The total number of registered FVCIs was 275.
And all of this brings us to the big, forward-looking question, doesn't it? We saw this huge rotation of money from stocks to bonds. So as the global economy keeps changing, will all these policy tweaks we talked about be enough to lure that foreign capital back into Indian stocks? That is the trend to watch.
I really hope this deep dive gave you a clear, solid understanding of the foreign investment picture for your exam prep. We've covered the rules, the numbers, the key trends, the whole shebang. If you found this helpful, do us a favor and hit that like button, share it, and please subscribe for more. Thanks for watching.